Hello and welcome back. This is Introduction to Accounting Part 5, the December 31st Accounting Party second example. Disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you modify the presentation in any way, please email me prior to doing so at bennett1812@gmail.com to discuss. Note, the author does not claim any copyright whatsoever in any companies or organizations mentioned in this presentation. Rather, the other parties are the owner of their respective copyrights. So we're now going to be doing our second example of just a balance sheet and recording balance sheet transactions. And remember, the reason why we're doing this is we need to get used to how to go through and record transactions into the T accounts. This exercise is only really for that purpose, and that purpose only because in reality, businesses operate beyond December 31st. The other part of this is if you're already skipped ahead, you'll notice I am not having any revenue, expense, or dividend accounts. The reason is because, again, we're just preparing a balance sheet. We're doing all of our transactions on one day. And this is to help you learn more accounting more effectively. With this question and with all of our questions, we're going to be using Tchaikovsky's T theory of accounting, which essentially is my way of helping you record transactions into T accounts. All of our transactions will be taking place here on December 31st, and we're going to be preparing a balance sheet. So here's our second example. On December 31st, 2017, all the following transactions occurred for Larry Inc. And here's A through H. So we've got a total of 8 transactions. So we're now going to go jump to a Google Sheet. And here we are. So here are all the different transactions we have to go through here and do. And to kind of, as a reminder, if you need help going back and you can't remember, I would go back and take a look at the video, which kind of goes through and basically talks about what's an asset, what's a liability, what's owner's equity. Go ahead and take a look at that. Here, first thing we want to remind ourselves is our AELOE, or assets, equals our liabilities plus our owner's equity. We also remember the overlay on the top of it, or the DC. Okay, so this is debit credit. Remember, we cannot do this as a banker would do. Forget about what you learned from the bank statements. What we're really focused on here is for financial accounting. As a reminder, if we are recording an asset transaction, assets typically have debit balances. They are increased with debits and decreased with credits. Liabilities and owner's equity account typically have credit balances. They will be increased with credits and decreased with debits. The first part we have to do is we have to go through and record all of our transactions into T accounts. Once we've done that, we're going to total up the T accounts. We're going to make a trial balance, which essentially means that do our total debits equal our total credits? And then we're going to prepare a balance sheet as of December 31st, 2017. The balance sheet is a snapshot in time. It tells us on one particular day as to what a company's assets, liabilities, and equities are. And if that doesn't make sense, if I use, say, balance sheet for the year ended December 31st, 2017, that would be misleading. Why? Our cash balance or our asset balances changes every single day. So balance sheet is a snapshot in time. It's telling us on one particular date what our assets, liabilities, and equities are. So our first transaction here is Boost, Chuck, and Demetrius each contributed $50,000 cash to LI in exchange for common stock. So I am doing this from the perspective of LI. And so what I have to do here is say, well, how much cash is LI receiving? Well, they're not getting just 50,000 because again, we have to make sure we're looking here at the what the wording is. And here it says they each contributed $50,000 cash and received common stock. So Boost, Chuck, and Demetrius they each put in 50 grand for a total of $150,000. So the LI received cash of $150,000. And for every debit, we need a credit. Well, what did the company give them for that cash? Well, the company issued common stock. So they issued common stock valued at $150,000. Note here, when I'm going through and doing this, I'm not concerned with common stock par, additional paid-in capital. We'll do that at a later chapter. I'm right now just calling it common stock. I don't want you drinking through a fire hose. We're going to do this a little bit at a time. Okay. Then we have Larry contributed equipment valued at $100,000 and received common stock. The reason why I put this on here is it doesn't necessarily have to be cash that's being contributed to a company when you're starting it. It can be equipment, it can be patents, it can be different types of assets. So here, Larry is contributing equipment and received common stock. So if I'm Larry Inc., what I'm receiving is I am receiving equipment. And I'm receiving equipment here of 100,000. And let's do something real quick for this cash. This was transaction one, or excuse me, this is transaction A. And over here, common stock was also transaction A for this first one. And the reason why we want to go through and write these little letters in as we're going and doing the questions is I can go back and later check my work. Transaction B, they received equipment valued at $100,000, and then they Larry contributed equipment, and I should say here, and LI issued common stock. Okay. All right. So here I'm giving up $100,000 worth of common stock to Larry. And there we go. And to make this a little bit easier, because I know that this can be a little bit confusing, because like Larry giving to Larry Inc. So we're going to say Edmund or E contributed equipment valued at $100,000 and LI issued common stock to E. Okay. So there we go. Can I change questions on the fly? Yeah, I wrote it. So there you go. Okay. So that's what transaction B. Okay. Transaction C. LI received a $90,000 bank loan. The loan requires LI to pay interest of 9% and will be payable on June 30th, 2019. Remember, all of these transactions are occurring on December 31st, 2017. So when I look at this one right here, LI received a $90,000 bank loan. So LI received cash of $90,000. And in exchange, or I should say not necessarily in exchange, but they received $90,000. what's going to happen here is that I'm receiving $90,000 of cash. Cash is an asset, so I show that increase with a debit. Okay, I'm going to show that increase to cash with a debit. For every debit, I need a credit. So here it is going to be a loan payable. And this is transaction C, excuse me. Morning coffee has not fully hit in yet. This is transaction C. And again, well, what kind of account is loan payable? Well, loan payable is a liability. And right here, it tells us that the loan requires LI to pay annual interest of 9% and will be payable on June 30th, 2019. So again, this is a liability. Going back to these other earlier questions, when I received equipment from Edmund, I'm receiving equipment. Equipment is an asset as it's giving us future economic benefit. I show an increase to my assets with a debit. On the credit side, in terms of common stock, I'm issuing or I'm giving common stock to Edmund. So I show that credit over here as a credit to common stock. Common stock is part of owner's equity. Owner's equity typically has a credit balance, is increased with credits and decreased with debits. Okay. My next one here is I purchased equipment for $3,000 cash. So what's happening here? Well, I received equipment for $3,000 and I did it by paying cash. Now for LI, cash is going down. So here, I'm going to show a credit here for letter D for $3,000. For every credit, I need a debit. In this case right here, they received equipment for $3,000. Okay. So does it make sense that I'm debiting equipment? Yes, equipment is an asset. I'm receiving equipment, I purchased it, so I'm going to be debiting that here as an asset. Okay. My next one here is LI purchased a building from Dallas for $100,000. LI will place a down payment of 15% cash, and the remaining will be payable to DI by January 31st, 2019. So over here, so I'm purchasing a building from Dallas, and I'm paying a down payment of 15% in cash. So, how do we want to do this? Well, the first thing we can do is we can essentially here, we know that we are receiving a building. A building is an asset, and we're going to show that debit to this asset here with a debit to essentially a building account. Now, could I combine this building here with the equipment? Absolutely, yes. We can call this property, plant, and equipment. And I can put the 100,000 down right here, or I can call this a building. And in this case, I am going to call it a building over here. I'm going to debit building for $100,000, and this is transaction E. Okay. So I'm debiting a building. It's still an asset because it's giving us future economic benefit. How am I paying for this building? Well, I need to make a down payment of 15%. So let's see how this works. So for the building, let's go down here to transaction E. So here for transaction E, my building cost was $100,000. My down payment was 15%. So total cash down is going to be 100,000 times that 15%, or $15,000. Okay. So that's my total cash down. So if I'm making a cash down payment of $15,000, what's happening to cash? Well, I'm going to be crediting cash here for $15,000. Okay. What's very important is that if I stopped here, I'd be in trouble. Right here, I have this building here for $100,000. I have a credit here for $15,000. Okay, I've made a 15% down payment. Does this balance? Do my total debits equal my total credits? The answer is no. So over here, we're going to have our remaining payment is going to be the $100,000 or the building cost less the cash down of $15,000. And this here is going to be giving me the amount on a note payable. Okay. So right here, the remaining amount, place a down payment of 15 cash, and the remaining balance will be paid by January 31st, 2019. Now, this is a liability. I have to pay this amount by January 31st, 2019. Okay, so right here, I've got this. Right here, I've got to pay it back by January 31st, 2019. So what do I do with this? I'm going to call this a note payable. Now in my class, could you call it a loan payable? The answer is sure, you could for your first exam. It's not the best answer because a loan is typically involving cash. A note is going to involve a building. So here, to finish up our transaction, I've got here this $85,000. I've got a debit here to a building for 100, credit to cash for 15, and a credit to a note payable for $85,000. So that is letter E. Okay. And again, does it make sense? Getting a building, that's an asset. I'm showing that increase with a credit. I'm decreasing cash. I'm showing that decrease to cash with a credit. And then I'm increasing my liabilities by $85,000 because I got to pay that money back. Okay. Letter F. I purchased $6,000 worth of inventory to sell at its retail store. The inventory was purchased on account and the terms were net 30. So as I go through and take a look at this, I'm receiving an asset, and the asset I'm receiving is going to be inventory. So let's do that part first. So I've got inventory, which is an asset, and the amount of inventory I'm receiving is $6,000. So I'm going to debit inventory here for $6,000. This is going to be transaction F. And here for every debit, I need a credit. Why is inventory an asset? Inventory is something that we resell to our customers. Okay. But am I paying cash for this inventory? Should I credit cash? And the answer is no. I purchased the inventory on account and the terms were net 30. What does that mean? Well, if I bought it on account, then what I need to do at the end of 30 days is pay the balance. So what we're going to be crediting right here for this transaction is not going to be cash, but it's going to be accounts payable. Does that make sense? Well, accounts payable is a liability. I'm increasing my liabilities because now I have to pay this $6,000. Okay. Letter G. I loaned Johnny $4,000. Johnny will repay the loan in January 2019. The loan will bear interest at 8%. So if I'm loaning Johnny $4,000, Johnny's going to repay the loan in January. So what's happening to my cash? Well, in this case right here, my cash is going down. I'm giving money to Johnny. So if I'm crediting cash for $4,000, what am I debiting? Well, is Johnny going to have to pay me back? Okay, as long as he doesn't die at the end of The Outsiders, which he actually does. But in this case right here, what we're going to call this, just remember to stay gold, pony. What we're going to call this is a loan receivable. And this will be right here for $4,000. We'll just leave this here at 4. Okay, we're jumping ahead. Okay, so what is loan receivable? Johnny owes me money. That's an asset. Johnny's going to need to pay me $4,000 in January of 2019. I don't care right now about the interest. The interest is going to be when the loan is actually outstanding for a period of time. Remember, we're in fantasy land. Everything here is happening on December 31st, 2017. So there's no interest on any of these transactions. Okay, last one here, Stephen Inc. gives LI $9,000 as an advance for inventory to be delivered in January of 2019. So right here, I'm receiving cash of $9,000. And this is letter H. So I'm receiving $9,000. Okay, Stephen gives Larry Inc. $9,000. So I'm debiting cash for $9,000. For every debit, I need a credit. And here, I need a credit for $9,000. And what do I call this? Well, if I go back and look at the transaction, they're giving me an advance for inventory to be delivered in the future. So what we call this, and if you saw one of my earlier videos, this is kind of similar to Tesla. A customer deposit, you can call it unearned revenue. Either answer at this point is technically correct. The more important thing that I want you to understand is that this is going to be a liability. So what we're going to do here is we're going to call this unearned revenue / customer deposit. Either one of these for my exams will be fine. Again, I'm more concerned when you are going through and doing these types of questions that you understand what is an asset, what is a liability, and what is owner's equity. So what we've done here is we've gone through and we've recorded all of the transactions into T accounts. If you ever take one of my exams, I will be providing you blank T accounts without names, or I may provide you more T accounts than you actually need. And it's going to be up to you to go through and post these into transactions. So right here, what I'm going to do is once I've gone through and I have entered in all my transactions, I now need to say, do my total debits entered equal my total credits? So for this part right here, what I'm going to do now is I'm going to total everything up. So the only hard part in terms of totaling up is going to be in this cash side. So here I received cash for stock that I issued of $150. I got a loan of $90 and I received a customer advance. So on December 31st, I received a total of $249,000. But I also paid for equipment for $3,000, made a down payment on a building for $15,000, and I had this $4,000 payment that related to a loan that I made to Johnny. So right here, I've got total credits of $22,000. So my net cash balance, I'm subtracting the smaller from the greater and leaving it on the greater side, is going to be $227,000. For common stock, I have the cash issued for stock, and then I had the $100,000, which was my stock issued for equipment. Loan receivable, $4,000. Customer deposit, unearned revenue. Inventory, building. Loan payable, note payable, and then here, accounts payable. So I've gone through and I've entered in all of my various different accounts. I'm going to pause really quickly while I go through and then make up the next tool for us to do the trial balance. My next step is, once I've entered in everything into T accounts, I'm going to move these final balances here to a trial balance. So give me a second, I'll set that up. So we're back. The next tool we're going to use is something called a trial balance. This is not an official financial statement. This is a tool we use to make sure that total debits equal total credits. So here, debit, credit. And right over here, LI, trial balance. We'll just call this 12/31/17. And all we're doing here is we're moving our balances that we recorded in this transaction over to the trial balance, and we're going to make sure our total debits equal our total credits. Now, if you saw my last video, the way I like to do this is I like to write out assets. And I'm going to have here liabilities. I'm going to come down here to owner's equity. Why am I doing this? What does our balance sheet represent? Our balance sheet shows us assets equals liabilities plus owner's equity. If I set up the trial balance like this, my final thing I'm going to have to do is to do a balance sheet. I don't award a lot of points on my exams for a trial balance, right? Notice over here, it's kind of sloppy. Different fonts, like what are you going to do? My students would probably start yelling at me for this, but in any event, I don't really care, because the reason is that this is just a tool that I'm using to make sure that my total debits equal my total credits. Once my total debits equal my total credits, I can then prepare my balance sheet. So over here for my assets, I'm just going to go here, start listing out my assets. Cash is an asset, and that had an ending balance of $227,000. Common stock is an owner's equity account, so I'm not going to do that here. I'm listing out my assets. I've got a loan receivable here for $4,000. I have inventory of $6,000. I have a building for $100,000. I have equipment for $103,000. Remember, I could have combined both of these accounts and called it property, plant, and equipment. I chose not to do it. Again, we're learning here today, but in the future, you can combine those amounts. And then lastly, I'm looking at here for any other types of assets, and all I see are liabilities. So my next group that I'm going to be inputting in here are my liabilities. Why am I following this methodology? The reason why I'm following the methodology here is mainly because what I need to do is, at the end of the day, got to make sure my assets or my total debits equal my total credits. So here, my first liability is unearned revenue. This is a credit balance here of $9,000, right? Liabilities typically have credit balances. Make sure you get this on the appropriate side. Accounts payable, credit here of $6,000. Notes payable, credit here of $85,000. I have a loan payable right over here of $90,000. I think that's all my liabilities. My next area is going to be my owner's equity. My owner's equity, I have one account in this type of transaction, which is my common stock, that has a credit balance of $250,000. So what I've done here is I've totaled up all my debits and my credits. So when I go through and do this, I'm now looking at here, I have total debits, $440,000. I have total credits of $440,000. My total debits equal my total credits. It doesn't mean I necessarily got the answer correct, but what it does mean is that I can go through and prepare my next step, or my final step, which is going to be my balance sheet. Again, it's a trial balance. I'm just showing my total debits equal my total credits. Many of you, and I've had several bookkeepers who have taken my classes before, and what they always will say is, wow, I can run these reports on QuickBooks, no problem, but now I actually understand where the numbers are coming from. And this is where they all come from, are from these different raw transactions. Okay. So once we've done this, what I am then going to go through and do is make my balance sheet. What is a balance sheet? It is AE, LOE, AE, LOE, or assets equals liabilities plus owner's equity. When I'm doing the balance sheet, is I'm showing that on a particular point in time, the snapshot in time that my assets equaled my total liabilities plus my owner's equity. So right over here, I'm just going to pause while I. Okay. So here is my skeleton. And when we're doing a balance sheet, when we do the heading, we're going to say Larry Inc. Or you can say LI. I'll call this LI. Normally we just call it Larry Inc. Balance sheet. And this is going to be as of 12/31/17. So the first thing I do here, and if you see this, how I set this up, I'm going to list out my assets. I'm going to show total assets. I'm going to show my liabilities, which are going to be my total liabilities, owner's equity, listing out my owner's equity. And I'm going to show total liabilities plus total owner's equity. This must equal total assets. And if you go back and look at why we were going through and setting up the trial balance this way, if we've done it this way, it makes us much easier for us to actually go through and do a balance sheet. So organization is really critical when you do accounting. And I know this looks painful to go through and do these types of questions repeatedly. I can tell you without hesitation that this is the best way to learn it. It's repetition. The more times you do these problems, the easier it's going to be. Failure to practice is practicing to fail. If you do not practice, it's not going to come through, especially in accounting. Does practice mean, oh, I'm watching a video, this is sweet? No, I make it look easy. That's my job. Okay. You need to put pencil to paper. Keep the answers open the very first time you go through and see it. And if you have a question on it, go back through and watch it. You have to literally work through these problems like 5 or 6 times all the way through. That's the only way you're going to get better at accounting. So right here, cash, loan receivable, inventory, building, equipment. So I got cash here of 227. Going down here, total assets are going to be $440,000. And one of the other things I'm going to mention right now, and I've probably said this on other videos, if you do not take Microsoft Excel and you're working in business, you're a moron. I don't know what else to put it. It's the best of Don Rickles. You have to, excuse me. Wow, that was kind of strange. You have to go through and, wow. You have to go through and practice, and you have to go through and do these questions. That's all I can say. You have to go through and practice. Okay, so liabilities, unearned revenue, accounts payable, no payable, loan payable. Notice here, as I mentioned on my other video, I do not show debits or credits. We do not use debits or credits on the balance sheet. Very, very important. It is improper form. Here, you can write it like this. I'm doing the indentation just so you can see as the reader that it's easier to do it this way, or it's easier to visualize. Okay, so for liabilities, unearned revenue, accounts payable, no payable, loan payable. So my total liabilities are going to be $190,000. So put an underline under that guy right there. And again, the underlining is just because every instructor does this differently. I don't really care, or I do care, but not on this video. Common stock, 250,000. My total owner's equity here is 250. And then I get to my total liabilities and my total owner's equity, and that's $440,000. So right here, I've got $440,000. And does that equal my total assets? The answer is yes. So again, as you're going through and doing these questions, I really want to encourage you to repeat over and over again. These parts over here, you're learning a new language. It's not actually not a new language. You're learning a new way to, I'm contradicting myself. You're learning a new way to record transactions. They have to be recorded in a certain way. And so the more you practice, the easier that this is going to get. It is literally putting pencil to paper. I cannot emphasize that to you enough. Please, please practice. Okay, you can watch videos. These are great videos. They're not as cool as Fortnite videos, but they're pretty cool. So, at least for accounting. So again, please go through and take the time to go through and study these questions. The more you repeat, the better off you're going to be. And I would really recommend, before you start doing the larger equations, those other types of things we're going to be doing shortly with revenue and expenses, you have to get this part down, because if you can't do and you don't understand the basics when it comes to recording these types of transactions, it's going to be a bad day at the office. And we all want to have good days at the office. So again, thank you for joining me here today. Please do not forget to like and subscribe, and I will see you on the next video. If you have any comments for me, please feel free to send me an email, or you can actually make a comment on this YouTube video to Bennett1812@gmail.com. Thank you so much for your time today, and have a great one.